We've talked about your earnings a little bit here. You were spot on what was forecast for your earnings per share at 30 cents. That's for the fourth quarter. You beat a bit on revenues, but take us behind those numbers. Give us a sense not only of the vehicle sales, but also of the profitability picture looking backwards into 2016.
Well, when you look at 2016, David, we had a very strong fourth quarter and strong full year. And as you mentioned, it's in line with the guidance that we've given. And we actually had a number of second best ever records. We had our second best ever adjusted full year company pre-tax profit of $10.4 billion, an operating margin, a very healthy operating margin of 6.7%, and our second best cash flow at $6.4 billion. And importantly, behind that, peeling that back, some of our regions put in some really great performances. Here in North America, a margin for the full year of 9.7%, a record profit in Europe, our second best ever profit in China, and also all-time record sales. So it was a very, very positive year for us, and our cash liquidity is strong. And we distributed $3.5 billion to our shareholders last year. So a very good year following a record year that we had in 2015.
So I'm glad you mentioned that mix between the United States, North America, and overseas. You have, as you said, record profits in North America. At the same time, vehicle sales are softening a bit. Are you shifting in overall toward Europe and China? I mean, you were profitable in Europe, I think, for the first time last year.
Well, we're actually, one of our objectives as a company is to get a better balance of profitability. And as we get into 2017, we do expect that our profits are going to continue to be strong. But also at the same time in Europe and in China, we're going to continue our positive performance there. We do expect Europe to be down a bit this year, again, and that's based on the weakening of the sterling because of Brexit.
So I'm glad you mentioned 2017. Let's take us forward now, because you're indicating 2017 might be a little bit softer. I understand basically based on your new initiatives. That's autonomous vehicles, electric vehicles, things like that. Tell us about those plans and what they will do to your bottom line.
Well, when we look at 2017, we're going to have another good year at Ford. It will be a bit down from last year, and the reason for that is because we're investing in emerging opportunities around electrification, autonomous vehicles, and mobility, which will open up more growth opportunities for us down the road. So we're investing for the medium and the long term, but still putting in a very good year that we're projecting for 2017.
So, Mark, one of the things that you'll be dealing with in 2017 is a new president. And as I mentioned already, you've met with him twice already. He mentioned even in the Roosevelt Room, that second meeting, that he'd seen you twice in 2 days. So, first of all, just give us a sense now, as you've dealt with him as president, what sort of a person is he going to be? How is it going to be to do business with him? What do you learn from those meetings?
Well, I think the president is going to be very good for business and the economy. And first and foremost is because he's focusing on it. David, I think it is very, very positive that his first couple of meetings in his new administration under his new presidency, he was focusing on manufacturing and automotive, and he's going to be very focused on driving policies that will looking to drive investment and job creation overall in American manufacturing and in automotive manufacturing. So I think it's very positive that he's focused on the economy and he's listening. And he's understanding from our standpoint, the suggestions that we have to grow the economy going forward.
Yeah, and one of the ways he wants to grow the economy, particularly in the United States, is for you to invest more in plants in the United States. At the same time, where you are on the cycle, because there is a cycle to this vehicle sales, isn't this the worst possible time for Ford Motor Company to be putting forward billions of dollars in new capital investment in manufacturing facilities in the United States?
Well, let's put it into perspective. Our view is that the market here in the U.S. Has plateaued, but it's plateaued at a historically high level. And also, when you look at the segmentation in the marketplace, people moving from cars to trucks and SUVs, that plays to our strengths. But we're going to be very judicious. We're going to do the right thing for the business. Earlier this year, we announced that we're going to invest another $700 million in our plant in Flat Rock, Michigan, and also create 700 jobs. We're going to make sure we're doing the right thing for the business, understanding where we are on the cycle. We don't have any plans to build any new plants, but clearly we want to continue to grow our business and use the assets that we have as best as possible. And if we have a good business environment for manufacturing here in the U.S., that's one of the factors that we look at in our investment decisions.